To Elite
Just
Trading.
checking. Can anybody hear me? Because I can't hear anything at all.
George, you just interrupted right as I was introducing myself. Thank you. Welcome to Elite Trading. My name is Gaylor, and I'm coming to you live with Training Tonight. And we're excited to have everyone in here. We're going to get going, and we're going to have a great session. We have myself and Big Freddy in the house giving you the Q&As, the answers to the questions, and we're going to run down anything you need to know. Fred, if you need me to pull up charts, if you need Blake to pull up anything, make sure you let us know and we will pull it up for you. Don't worry, we have you handled and covered. And I'm excited to be here tonight. I hope you are. And we welcome you, Blake, George P. Winfred, in the house. Let's get it going and let's start this training off right. Tonight, we're going to go over what I have together for you as implied volatility. And when we go over implied volatility, I want you to see that we have Blake showing off his screen here, and we're going to go over all the topics together. Basically, it's going to be a pretty easy session tonight. We're going to go over what is intrinsic value, and then we're going to kind of go over a few topics that you guys bring to the table for us. So George, the big winner tonight, we're going to announce right off the bat. George is the $100 Amazon winner. George P. Big dog, George P. in the house. I'm so glad that you won. I told Blake, I said, this guy's in every training. He deserves it, and I'm glad that you won it. So we're going to kick off what is intrinsic value here, and we'll go ahead and get the next slide here. That's me. What is intrinsic value? How can you use this to your advantage? Value before expiration at time. So when you're looking at this chart, you're looking at a time and a strike price. So you're seeing the value of a current position, and you're also seeing the ending of the value of the price. So that's what the top where it says option value, that's going to be the price. And then when you have the asset spot price, that's going to be as it goes on, whether the intrinsic value raises or lowers. So next slide. We have the intrinsic value and time value. Stock price equals $56, and the price is a $50 strike call option. So it's an $8. So if you're looking at this, basically what it's saying is that you're paying an $6 intrinsic value, and the current stock price you can is at $56. So you're paying a time value of $2 and you're paying an intrinsic value of $6. So that makes your option premium or price $8. So if you're able to buy the stock at $50, why would you pay $58 to be able to buy 100 shares? So that's what you're paying for at the time when you buy an option. You're buying this strike price for a later expiration and expecting the stock option or the stock price to move up over the $50. Well, it needs to move over $50 plus the $8. So if you were to buy the shares, it would cost you $500. At this point, it's costing you $508. But you're paying an $8 premium for the intrinsic value that there's a certain amount of time frame that the underlying value or the underlying asset may move up over that price. Next slide.
That's all there is.
On this one? Well, either way,
Yep.
that was easy enough. That was simple enough to give you guys the idea of what intrinsic value is on that standpoint. But I will elaborate further. It looks like my media team here is failing me, but it's okay because we are still working out the kinks. But basically, when you're looking at intrinsic value, what that means for you is you're buying an option. You're buying a position in a stock, believing that it's going to move up in a certain amount of time. And when you buy this call option, believing that something's going to move up in a set period of time, you are now giving yourself a hedged position or a go-ahead position, saying that you believe that you're going to beat the other person. They're giving you an option saying, I'm going to sell it to you, thinking that the price is going to go down. And you're buying it from them betting against them thinking it's going to go up. So if let's say you own 100 shares on a stock that is currently at $50, well, you own it for $500, right? And now you are looking to, or I'm sorry, 5,000, and you're looking to sell this stock to somebody else at $2.50 above where your current price is. Well, let's say that there's a 52.50 call. So that means that you can now sell a call to somebody else, which gives them the option to buy 100 shares from you. Well, if you're break even and you sell it to that person for $8 over the current price of the strike, then, or the current value of the stock, then you're now implying the implied volatility. You're implying the intrinsic value. You're implying that it's going to go up. So you're charging them a premium for that fact. Well, as it rises, you're now going to take the profit from your position that you hold, the 100 shares, and it's going to rise all the way up to that $2.50 profit of 52.50. That person can now exercise that option and they can buy your shares for $2.50. So now you make the profit there, but you've lost that intrinsic value, which is the value that you charge them for that contract. So when they exercise it, you lose that value. Now, if the value of the contract stays the same or it goes down after you sell to them, then that intrinsic value will go down, and now that option will now lose its intrinsic value because you're now seeing the price of the stock go down. So therefore it loses the idea that it can move up to a higher price. So therefore people are selling the option at a lower price and people are offering to bid at a lower price. So once someone starts to bid at a lower price and the ask goes to a lower price, the implied volatility will go down. So therefore the intrinsic value goes down, and there's no longer a reason for someone to pay you more than what the current price is because they don't think it's going to go past that certain level. So long or the short is you buy something and you expect it to move up. If the stock does not move and it slowly goes up maybe 1 or 2 pennies a day, and a week goes by and you've lost a week of time, then your intrinsic value is going to drastically be impacted by that. Because the whole reason why intrinsic value is calculated is based off of the fact that the buyers and the sellers believe that the stock's going to move up or down in a said direction, whether it's down or up. And that is the extrinsic value and the intrinsic value. So if you guys have any questions about that, I'll open it up for you to talk to me about it. Anybody have any questions? Blake or Mickey or Toasty Panda, Winfred, Junior White, George P.
So I just got into the training course. I don't even know what she covered yet.
We were going over intrinsic value. If you want to just elaborate on, maybe you can even just put your 2 cents in, Mickey. I was just basically going over what it meant and gave a quick synopsis of, why intrinsic value is, or how it's calculated on a layman's terms. I didn't go over it in a fully technical standpoint. It was more of a roundabout and just telling them, hey, when you're looking at a contract and it's moving a certain direction, the reason why the price is reflected where it's at let's say the stock's at $50 and you're paying $5.08, why would you pay $8 over the current price when you could just buy the shares? Well, it's because you're betting that the stock is going to, or the value or the asset's going to move up in stock price over your strike during that expiration. And if it goes stagnant, then you would lose the intrinsic value because there is no longer the idea that's going to move past your level at that expiration, and therefore you would lose the price. So that way when you're selling that as well to somebody, if you sell that call option to somebody, then the intrinsic value for them would die down, and that's how you collect that premium when it doesn't go past $50. So if it ends up being at $49 by your expiration, then all that intrinsic value is gone and all of the value of the contract's gone, and therefore you collect that premium. And I was hoping someone might have a question or want to open up some discussion about it.
I have to unmute myself. Kaler,
Yes, sir.
can you explain that again, please? Like the intrinsic value part. Like, why would you pay the $8 more when you could get it for 500? The intrinsic value, does that mean like the hype of the stock? Or people are like interested in it, and there's a bunch of hoo-ha going on around it? Is that what that is?
Yes, with the price action. So like the fact that so Tesla, it has an intrinsic value based over a 52-day or 52-week period that the asset's going to move at a certain period. Let's say it's 68%. So the implied volatility over a year is that the stock's going to move from one direction to another 68%. So therefore, your timing is based off of where do you think it's going to move up or down from that current strike price or that current stock, or sorry, that current value of the share. And I like to use 50, or I actually like to use $10. It's easier for math. So if you have a $10 strike price and the company's at $10, then in your mind you're like, well, I should only have to pay $100 a contract. But if the asset has moved $2 at a time every week for the last 10 days, then the implied volatility is going to be higher because people are believing, hey, it might keep on moving $2 more. So therefore, the ask and the bid keep getting raised and raised and raised. And that's when you see these gaps as well, when the person that's holding the contract's willing to sell it for a further gap out than the person willing to buy it, because the person willing to buy it goes, hey, this thing's ran too far and it shouldn't keep on running. So your implied volatility is basically a hidden imaginary number in the air that's saying, hey, someone else believes that this contract's going to be worth more money at the end of the expiration than the current price that it's at now. And your idea is that but when you buy it, you want to buy it when you're closest to in the money as possible. So why would you buy the right to buy a stock at $55 when it's at 50? Because your idea is that you're paying that $5 premium because you're expecting it to go up to that $55 before that expiration, and the other person's betting you that it's going to go up or stay under that position or under that price by that expiration. So that's where that value comes in, is that it's just basically gambling. It's two people betting against each other.
Oh wow. Well, how far out would you buy something like that? I mean, like for Tesla, it seems like you could buy 3, 4, 5, 6 months out, and I don't know. It was at 605 this morning. I don't know what it's at now, but it just keeps going up. I don't know, but there's nothing else out there that keeps going up like that. So,
well,
what would you base it off of? How long would you buy it out
let's
for?
go the opposite way. So let's go the opposite way. Let's look at Kroger or Microsoft or another company Kroger's a good one, or Ford, where the contracts are 10, 20, 30, 40, 50 cents, right?
Right.
And then you look out 6 months later, guess how much they are? 80, 90, 100. They're not much more, right?
Okay.
Because the implied volatility is so low that nobody expects it to move. So when you get that 5, 6, 7% move out of Ford in one day, that's why those contracts go from 70 to 100. You gain 30% on your contracts in one move. It's because that old implied volatility is out the window, because now they got to go, holy crap, it just moved 7 or 8 to 20% overnight. Now they're like, well, maybe it could keep going. So now the implied volatility goes up because people aren't willing to sell them anymore at the lower price. They're wanting more money. They're asking higher, and the bids are going up.
Right. See, because I remember Ford was like at $6 and stagnant, super stagnant. Like,
yeah. So if you bought $9, you could have bought $9 strikes for a penny, because nobody thought they were going to move, and then you would have sold them for $90 a piece. A couple months later.
Wow. Right.
And can I chime in? Dude, great way to break down. I like the way you break it down, because this is a very confusing topic for a lot of people.
Watch the background noise moving around.
Sorry about that. I get my hearing aids in, so like they're Bluetooth to me. So great job breaking it down. One thing you guys gotta realize about intrinsic value. Number one, you should always know how to like, especially for stuff like finding the value of stuff. You should know how it's essentially done, right? So find the intrinsic value of any stock, right? You take the stock price and the option strike price, and then you minus the strike price, and then you with the option strike price that you're looking at getting in, and then you times it by the number of options that you plan on getting. That will give you your intrinsic value, right?
Wait,
So
say that
strike
again,
price,
Mickey.
yeah. So you take your stock price, like what this
Yes.
stock is currently trading at, and you take
Okay,
the
say it's $10.
option. Yep, let's say it's $10, and you minus it by this option strike price that you're looking at getting into. So let's say $5, right? So that gives
Right.
me $5, right? I plan on buying, let's say, 10 of those, right? My intrinsic value is $50, right? For that,
Right.
right? And then the thing you got to realize is options that aren't in the money means that the strike price is greater than the current share price, right? And it has no intrinsic value and is only trading only for time value at that time and the potential that the stock price could increase. So like traders usually use intrinsic value are the traders who are like the ones who buy like weeks and months out and then they buy in the money because they actually have intrinsic value. Am I pretty
So
correct
if
on
it's
that,
out of the money,
Caleb?
it doesn't have any intrinsic value.
Yo, so it's got value, right? But its
But
value is based off the potential that the stock price could increase and drive the
I
option
see.
higher. But it has
So
no
the
intrinsic value
hoopla
if it's
again.
out the money. No.
So,
Like it
No.
has time value, it doesn't have intrinsic value.
if you don't
Oh, I
mind, I
see.
will call him out. And never mind, I had Ben in here for a minute there, but Ben left. So I was going to call Ben now. But Winfred, Fred, do you want to touch a little bit of your insight on this? Freddie? Well, don't have Fred's audio yet, but I know he will interrupt him.
Uh,
Fred,
I
interrupt him when you can.
I do have a question though.
Yeah, go, Blake.
Would intrinsic value would it kind of be like hype like kind of like what a hype stock is, where like it generates hype for like the potential that it's gonna get big? Would that be kind of similar to compare or no?
It would give you the sense of relativity. So every option has intrinsic value. So no matter what the stock is, no matter what the price is, they all have an intrinsic value. It's whether the intrinsic value is higher or lower is based off of the volatility of the stock. So if it's a low volatility stock, you have a low intrinsic value. If you have a high volatility stock, then you have a high intrinsic value. So you can charge a higher premium for the call option because people believe it could go up, but it's when you hear volatility is to the upside and to the downside. It doesn't have a direction in particular.
Oh, okay. Yeah, that makes sense.
Right. That's what makes it risky, right? That's where the risk is.
Yes, the risk equals the reward. If there wasn't any risk, there wouldn't be a reward. That's why when you buy a Ford call, you might make $5 a contract over a week, and with Tesla, you lose $1,000 or make $1,000 in 5 minutes.
Yeah, in a day, right? Yeah. I kind of understand what you're saying, actually. It's crazy.
Fred, where you at?
So,
Winfred, where you at, buddy?
build up, does build up to earnings like news? I guess news would make the volatility rise on the upside, and then bad news would make it drop on the low side, right? Basically. So if a stock comes out and they're say a farm stock or whatever, and they come out and then they get shut down by the FDA because they can't do their whatever testing, that's volatility to the downside. Is that right?
Well, the volatility is already in place before the news has happened. So let's say that the news comes out and says, hey, this stock has been sitting in consolidation, hasn't moved between $6 and $7 for a year, and then all of a sudden they say Ford is coming out with the new engine for electric vehicles that's going to take them to the moon in a day, and then the stock goes from
Right.
$7.50 to $12. Well, now the implied volatility and the intrinsic value is going to go way up because there's more hype to the stock. So the whole point of finding things in a consolidation period is you're trying to find something that is before that volatility has hit, and you're putting together the catalyst, the news, the situations to be able to understand that there might be a catalyst that'll move the stock in a certain direction, whether it's up or down.
Ah, that makes a lot of sense.
Winfred, you're
actually.
moving. I can see you talking. Are you talking?
Can you hear me now?
Yeah,
Yes, sir.
Fred in the house.
Yes.
Awesome. Okay. Yeah, I had to go in
The
and out.
voice of an angel. Hey guys, before you start, if you cannot talk and you want to talk, it's because you either have yourself muted or you have to leave and come back and something's happened. And we are open. You're allowed to ask questions at any time. Fred, talk about a little bit of what your ideas are on implied volatility and intrinsic value.
I actually just had a question about that. I think which Mickey probably answered. Let me approach from a question standpoint. So if I have bought a stock, just as you were explaining, an option, and the option is the stock is worth, or the underlying is worth $50, and I paid $58 for it. Does that mean that unless the price goes above $58, I will make no profit at all?
No. That does not mean that. So if you, and it's actually 508 and
508, yes.
So the stock does not have to move across 508 for you to make profit on the contract. It has to make past 508 for you to make profit on you executing the contract.
Where you going?
On you executing the contract, that is on me buying the 100 shares.
Correct. So if you choose to buy the 100 shares, then you would have to wait for it to go past 508 for it to make sense for you to do so. But once you do that, you are also losing the $508 that you spent on the contract, or
Yes,
or whatever
yes.
the price of the contract was. When you exercise your shares, you lose the contract price that you initially paid to buy it, because all you're doing is
Okay.
you're buying yourself a position with the idea that you believe the stock's going to move across a certain price. So I think that a lot of the common misconception is that people go, "Hey, I bought this thing at $18. I said it was going to go to 20 by 2 weeks from now. Well, 2 weeks from now it's at $20. My contract's worth $30 and I bought it for $150. Well, because at the time you bought it with with intrinsic value attached to it. Well, once it gets to the date of the contract, if the stock's not above that by any amount, if it's right at it, then there's no reason for anyone to pay you a premium to pay for that option, because they can just buy the stock right there. So once you get to, as you get closer to your expiration, you lose that value because someone could just pay for the stock. Now, if you buy the right to pay $50 or $508 for, sorry, $50.80 for a stock, and then it goes to $60, well, now you're $10.20 in this, or $9.20 in the money, and you may want to exercise your position if you believe that the stock's going to keep on continuing to go. But if you think that was just a move that happened randomly that should not have happened, then you take your money and you run and you sell the option to somebody else.
Will somebody else buy it at that point though? If it goes from 50, 80 to $60, is there somebody else out there still willing to buy it at $60?
Always. There's always a bid.
Really?
There's just not always going to pay you what you want for it.
Oh.
Hey,
So if it
can I
ran
say one?
$9.20 in a week, they would pay less than $60, basically, right?
So here's an example. So let's say the ask and the spread, the bid and the ask are way apart. So this is a good one. Like Nikola, the stock moves $10 and you bought it for $100, and everyone's asking $560 for it, but really everyone's willing to pay $200. It's not worth $560. It's worth $200. That's what people are willing to pay for it.
Right. Wow.
Hey, can I take another stab at it, Kaler?
$5.
Because I think I could. Huh? Hey,
That is your
Don't
intrinsic
pay.
value.
okay, so here's how it goes, guys. All options have extrinsic value, and the farther out, time value comes into play, right? And the closer it gets to expiration, that time value goes away, and then we shift more so on the implied volatility, which all that is how much that stock price is going to move. Now, this is for out the money, right? And the whole reason extrinsic value is out the money based off of time value implied volatility, which it still has an effect once that stock goes in the money.
When you're out of the
Check it
money,
out.
it's I want him.
Yeah.
He's making a good point. I'm sorry to interrupt you, but he's making a good point. Write this down. When you're out of the money, it's extrinsic value. When you're in the money,
Yes,
it's
in the money, it's
value.
intrinsic.
value.
And
that's what we
extrinsic
started
value.
with. If you're in the money on a $50 call and you're looking at a 508, you're paying above the price because you're currently in the money. So I don't want everyone to get confused. So if you're paying for a strike price out of the money,
so think of it like this.
Extrinsic value.
Think of it like this, right? Intrinsic value, like that person, that stock is a performer because it's in the money. The intrinsic value is going to be what you profit off of. When it's out the money, it's extrinsic value, and it has two potentials that you make money off of it. It has enough time to get in the money, and it has enough movement to get in the money based off of the time. But like once you are in the money, like $1 to $2 to $3 above the strike price, you still have the time value and the implied volatility. But once you get higher in the money, your intrinsic value goes up. That's what you profit off of, and you lose extrinsic value because you don't need time value and you don't need implied volatility the more in the money you get.
And if you're new to options and you're buying something that's extrinsic value, and you're buying something that's out of the money, then you have to realize that if you're making 5, 10, 20, 30, 40, 50% or even beyond if you're lucky, then you're making money that should have never happened. So when you're paying for an option that's way out of the money, $10, $5, $6, even $2 out of the money on a slow moving stock, and you go profitable, you got to get out because it has time to not be in the money. So your idea is that you beat the clock, you won. You said, hey, it's at $100, it's going to go to 105 in 2 weeks. Well, it goes to 103 overnight. Get your fucking profit and take it, excuse my language, and get out. Because if you were at $100 and it goes to 103, then you have the right to hold it. But when you're out of the money and it moves up and you make your money, you need to get out and take your money because that extrinsic value does not hold.
Which is why you see like...
I'm sorry, everybody. Go ahead.
No, go on.
Where do the Greeks come into any of this? So say, you buy something way far out and you're hoping that the intrinsic value goes up or generates as this thing rolls along. You're looking at a daily chart and it's putting along at $7-8, and you're like, damn, this thing has got to go up. So
you're already
buying 6 months out.
I want everyone to know that, George, you're already starting off with the wrong mindset. You're buying something based off of a long-term play. That's not what options are for.
Oh, you're talking about a short term.
Options are always for the short term. You're just giving yourself time to make the profit. So whether you buy in January or February or March, you just want the move to happen. You don't care that it happens. If you make 30% tomorrow on something you bought for March, then take your profit.
You sold it. You're gone. I understand that.
Yeah, you're only buying options. You only buy options for two reasons. You either see a high volatility reason to get in, or you're protecting yourself and you're hedging yourself because you already own shares and you say, hey, you know what? If I own SRAC at $10 and it goes to 20, I don't give a shit if somebody wants to double my money. So what I do is I sell calls for $20 or I sell them for $15 and I sell them above what I own the shares for. Because when you exercise them, now I just made $5 a share. I made $10 a share. What do I care?
And boom, you're out, right?
And if they don't hit 15 or they don't hit 20, then I collect all the premium that I sold you.
One of the things I recommend is I shared a profit calculator for options. It kind of gives you a really good visual of what to expect when you buy options at certain dates. It shows you when and where you'll lose your money and how quickly you need it to move in order to make a type of profit you want.
The
And
probability
if you
chart
don't
is
see it
great.
doing that, it kind of gives you red tape of when you should definitely be out of it.
Wow. Okay. I'm gonna look that up too. Options calculator.
Like I just put it right there in the chat. I know that helped me when I first started.
Right. Because I see
But
that's what I'm trying to figure out. Like I like to day trade, but I don't understand how to options day trade. So I'm trying to
Yeah, you got
figure it
to
out.
understand what the option is so volatile. So if a stock you're putting the grease in there, it has a theta of $1, 1.0. So that means that every
Right.
day,
That was my next question. The Greeks.
your stock is going to go down. Your option price is going to go down $1 a contract. So if you bought it for $200 and the next morning, if the stock stays completely stagnant and doesn't move at all, and it has a theta of $1, then you're going to lose $1 a contract. Now you're down $100.
Mm,
Now, if the
right.
stock has a delta of $1 and has a theta of 50 cents, then it moves $1 up the next morning. You should be up relatively 50 cents a contract.
So the theta is against you. The delta's for you.
Yes.
Got you.
And then your gamma is the calculation of the delta. Right?
I'm sorry, I didn't catch it. The gamma is the what?
The gamma is how they calculate the delta.
And the theta.
No. But I'm having a brain fart. Winfred, how do they calculate the theta? Or Mickey? I'm having a brain fart. I don't have it in front of me. I can pull it up if I forget the name of the word, but I can pull it up here. Hey, we're not flawless.
No, we're not. We're only people, dude.
Sorry, the rho, the vega, and I had that wrong. Sorry, the vega is what calculates your theta. If I have this right, and your gamma calculates the delta. Okay, yeah, that's right. So, when you're looking at this, what we're talking about is that you can pull up a probability chart, and I'll pull up this and I'll add it to the live chat. And this is one for Tesla, and it's a probability chart of how options work. And if you see this information, it should help you kind of break down an idea of what I'm talking about. If you guys want to go to your live chat and pull up that screenshot I put for Webull, and what this shows you is a probability chart. And I can actually, pull this up for the group here. It's watching us live, and go to the live chat. Boom.
Is it on Blake? It's on Blake.
I
Can you make that bigger?
Open original. So what it's showing you is that there's a probability. It's a curve, and this curve is giving you the fact that it can move from 606 to 677 on that date. By January 15th on 2021, it's saying it can move from 542 to 742. I'm currently short the position, and I want this stock to move towards the downside. And my probability for that, where it says here at the bottom, is that I have and what I like there is I bought past the current frame. So what it's showing is by December 31st, for it to be below 577 is a 24% chance, and 28% chance it's going to be in between 577 and 641. I need it to be below 630 for me to be in profit, right? By January.
Wow.
And that's all I care about. As long as this stock moves below 530 in the next 2 weeks, I'll be okay. Now, if it moves up another $30, then now I need it to move below 660 in the next 2 weeks, right? Because I'm going to have to leverage myself in again. Because I'm talking about if it doesn't move up $1. Now, if it moves up again overnight, then I'm going to have to compensate for that now.
Shit, I don't understand. I've got shares of this thing at 415. Should I hold or should I go?
I would have sold. I would have sold a long time ago. So you got more profit than what I would have had because I had calls for them
I've
when
been
they were at
selling a lot.
$100. So trust me, if I would have held them, I'd be I wouldn't. I wouldn't be talking to you guys right now. I'd have 20 other guys. No, I'm just kidding.
You'd be on the beach sipping margaritas somewhere. I hear you.
I tell everybody
Yeah.
my biggest problem is that I don't hold profit long enough. You know, I sell quickly and get my 5 to 10% because I'm all about making this a career. If I was out here
I
doing
absolutely
lotteries, then
feel
I'd be a
that.
millionaire.
I feel that
Right.
100%, man. Like that's the bane of my existence is if I would have, man. It's like that kills me every time.
But don't be, because once you get to a position where you say, you know what, the if I would have is gone, it's not about that. Because there's a lot of times where I went to the car dealership and I said, hey, if I would have went there on my day off, then I would have sold 3 cars because they had a really busy day. But really, would I? It's not that way. It's just because you would have held a certain position. If you would have held, would it have been profitable or would it have been negative? It's that I don't care
Oh,
about the
right.
what ifs. All I want to know is that if I can make 5% every day on my dollar, then I'm going to be a rich man.
Absolutely. But and I also see there's also a value to the if I would have because it's like, okay, I didn't. Why? These indicators. Okay, what else did it signal to? So I kind of take like the loss as sort of a gain. I'm like, all right, good. It's gonna teach me something.
And I want everyone that's new to options too to understand that options should be about 10% of your portfolio. So when you're trading, you
Yeah,
do
of
not want to
course.
be trading options as a primary source as your daily trading. This is a roulette wheel inside of the casino, and we are teaching you
Right.
something that is not um, widely taught. Is you don't have a lot of groups that are regulated or professional like ours. You know, we if you want to look us up, we're Elite Trading LLC. We are a legitimate investment club. So when you look at us, there's not a lot of investment clubs that are dealing with options because of the risk that's associated. That there's not a lot of big money that wants to get involved. Now you have to find big money that has enough big money that wants to put tens of thousands of dollars aside and risk it on something that's for fun. And this is where new retail traders or anyone that's wanting to learn these things, they need to understand that this is not a game where you walk in and put $1,000 on 35 and realize that you just lost $1,000 on one spin. You need to realize that you need to
Black.
hedge yourself by going 50 on black and maybe going $13 on the inside looking for a 35 to 1, but your big move is that you're betting on black and you're because it's a 50% odd. That's buying shares. You're not buying shares when you're buying options. You're just buying a contract. You're buying a high risk contract. So now you have to tell yourself, okay, how do I walk into this and give myself the idea that I can make money doing this and also protect myself? So options were derived from someone basically wanting to protect their investment and to the upside or to the downside. And that's what you have to understand is when you're doing this, that you're either gambling or you're protecting your position that you already own. White Fred?
Yes, sir. Yes, sir. I'm here.
What do you think, Fred?
I'm loving it. I'm loving it. I'm loving it. You're in the right path, so I don't want to interrupt, right? That's why I'm just listening up because I'm also learning just as we go along. So let's roll.
Hey,
Um,
that's great.
yeah, we've been talking about options volatility for a while now. Has anyone got any other question? Technical indicators, tools, platforms.
Yeah. What makes you think that all this is going to happen with the technical indicators that you have going on? I mean, like you're reading candles. How far out? Like, what's a good? Where do you start?
Okay, so technical indicators just basically you use them to give you a sort of edge in understanding where the value of an asset is going to be. So the value of an asset is based upon, and I think that was touched on the volatility when Kayla was speaking, is based on time and price. Okay, time and price at any point in time will determine the value of that asset, right? That is why the further out you are from a certain strike price, the implied volatility could be high, and which means that the intrinsic value, right, could also be high because you've got enough time for people to make decisions either to buy or sell, which can move the price either in your favor or against you. If it goes against you, remember, when it's going against you, it is going in someone else's favor. It's an auction process. Someone is winning and someone is losing. So, what you are using technical indicators to do is to give you to be able to hopefully identify a point in time when when a similar action happened and how the auction participants reacted to the price and price at that particular point in time to the value, right? When a week ago, when volume spiked, or when some news came, when the fundamental news came in, how did auction participants behave? And when I'm talking about auction participants, that includes you and includes me, both prop traders, retailers, the big banks, all those, everyone that comes in, everyone that is trying to place some value on the asset or on the stock that you're trying to buy. Okay, so now when we are using technical indicators, some of them have been this most of them are very good statistical values, right? They're calculating. If people have sat down over years and months of experience, they've gathered a lot of data, and they've noticed that when you are able to calculate the coefficients analysis, do coefficient analysis, regression analysis on a certain uh, you know um, period of data, then you can have some prediction, right? But you have to always bear in mind that every technique, not every, maybe 95% plus of technical indicators are all lagging indicators. They are not a crystal ball. They don't tell you what is exactly going to happen true tomorrow, but at least they give you an edge to tell you that there is a higher possibility of it going in this direction. That is why even after you've gotten that, you still have to protect yourself with a stop loss. That is knowing when you're going in and knowing when you're going to get out if things go against you. Hey, you jumped on the train thinking you were going down, you're going to New York, and the train was going in a different direction, going up to Massachusetts. Get off that train because that train is never going. It's never going where you thought it was going. Get off it, and then use another technical indicator to find yourself, to find a good position of where to go. Does it explain to you why we use technical indicators?
I think that it definitely covers, a very technical way of going over technical indicators. And my input would be that the way that Winfred puts it out there is very clear on a standpoint of someone that's a very advanced trader or even an intermediate trader. So anybody that's a new trader that's coming in listening to what he just said there, that's some very solid material. And what he's speaking on is that basically when you're looking at something, when you're looking at the Bollinger Bands or you select an indicator, it's all previous data that is portrayed as if it's real time, as close as possible as it can. It's giving it to you as quick as possible to your platform. Certain brokerages, they actually pay for that information ahead of time. So some of these big, high investors that are putting in their orders ahead of time, they get that information a lot earlier than you would on a free brokerage, Robinhood, Webull, things of that nature. So what you're looking at there is previous data that it helps you give you an indicator, which is why the word's there, of what may happen in the future. That's why they say that history doesn't repeat itself, but it often looks familiar. And typically when you see a pattern, it will continue to replicate into the future based off of previous behavior. So when you see previous behavior start to react the same way, other people will react to that behavior because they're saying, hey, I think that this is going to go this way because every time I've seen this thing hit this certain number or hit this certain way, it's indicated a position to go higher or lower. And they've put all these indicators together, and different people, which I don't like to say this, but you have to call it what it is. I call a spade a spade. When I do my lines, that's an elite trading indicator. So when you see my indicators of what I'm looking at or what the company's looking at, and you put them together with a Bollinger Band, with an RSI, and you're putting them together with all these different things, volume, VWAP, and you see that it's breaking the VWAP, and the VWAP happens to be touching the line that you saw in elite trading that said, hey, this would be a positive line. This means it's going bullish. And then you also see that the volume is spiking, and you see that the price action is going up. You see that the bid is catching up to the ask. That's where you start to see these different things that are happening, and you put them all together and you create a plan for yourself, because when you start seeing these patterns on multiple stocks, then you can become a real day-to-day trader, and you can actually say, hey, you know what? I know this is going to happen because when I saw this guy wind up and throw that curveball with his hand over the top of his hat with his leg curled up to the right, and he was hiding his glove and he looked this way, he threw me the curveball, so now I can hit a home run every time he throws it that way. But then when he switches it up and changes on me, that's the same time that you have to switch up and change the play, like Winfred said. And just because you were on the plane to San Francisco, well, it might take a derailment and take a delay and go to Texas for a day. And once it takes that delay, it's time for you to get the hell out of there because you were right for a certain amount of time, but now it's time to go the different direction.
So, are you guys saying like the more confluence that you have, like things happening in an area, is the best indicator of all? Is that how that works?
George, there is no best indicator.
No, I know that, but I'm saying if you have multiple things happening in an area at one time.
Mm-hmm. Yeah. Well. So it gives you a level of.
Is that how that works?
Can you say that again, please, George?
It wasn't me. I'm sorry.
Right. Okay. So let me just add. That was a wonderful explanation from Kayla there. That's really beautiful. So we use technical indicators to definitely aid in our decision making, because without it, then we are literally just going to be throwing money out there, right? We don't know where. We just think that the price. No, you can't just think the price is going to go in a certain direction. Luck plays a role in winning in trading, but you cannot rely on luck alone. You've got to use some technical intuition as well. So if you look at, for instance, we've got an expert in the house here. When you look at Elliott waves, right? Elliott waves, it's something that someone has sat down over a period of time and studied that human behavior, okay, has got reacts. There is a pattern to how human beings react to the prices of an asset. And so they will chase, they will stop, they will slow down a bit, they will chase again, they will stop. And when you identify that pattern, the first leg has happened, the second leg has happened, you know how the third leg is going to happen. So that is why, I like chartists. Some chartists are extremely good. So it's something like the Elliott wave, as I mentioned. Someone can carefully look at that and tell you that after this is just a correction, and it is going to go to this level, and from this level, chances are you now have a takeoff and is going somewhere else. Okay, great. Now that is all beautiful. If it happens, you have to win when that happens. If it doesn't happen, get out. This time it didn't work, but the possibility of it repeating itself, it's always there. And that is all you should be looking out for. Right. So sometimes it's also good to back test. Go and look in the past. How did it happen?
And what he's saying is like, let's say that you're in the right position, and this is something that I tell to my students all the time, especially if you're listening and you pay me the big money. That I tell you, like, hey, You know, at the end of the day, we're not looking to make 40% and hold. We're making that 40%, you get out, and then now you look for another position to get back in because you're going to find a spot where other people are willing to take that position. Now, sometimes you're going to be wrong. Sometimes you're going to take 40% and you could have taken 80%, and then now your next time to buy is higher than when you sold before. And that's something that a lot of new traders are never going to be able, not sorry, that they hardly ever can do is pay more for something that they've already spent the money on and sold because they're like, well, I've already bought it and I sold it for 60% profit. It can't go up anymore. That's not the way you want to think about it. Your idea was I made 60% on the move that I had the idea on, and now it's time to find my next move and find my next entry, even if it's above where I paid before.
Yeah, and a good example of that is I've been pretty vocal in the Discord about SRAC, and I bought 230 shares and I just held it, while at the same time Kayla was playing it on pullbacks, and we made roughly the same amount of profit.
And I
That's
left zero risk on the table. So like
Yeah.
what he's saying was is that I bought 800 shares and played the same play he did on a higher level, and I made a higher level of income the next morning, and I got out because I made so much money I didn't need to I didn't need to be in it any longer. And then I waited for another level, and he's like, well, I'm holding. He's like, these pullbacks happen, and I'm like, no problem. And I was like, okay, your pullback that you're waiting on, I'm making money now on the way down on that pullback while you're waiting to make more money on the upside. And I go, so now I sell my profit, make 20-30% on the downside, wait for it to consolidate. And I know it's going to keep going up in my heart. And I like this stock, but I still know that there's going to be a pullback. So I want to make money on both angles. So I know where I find support. And if I see that I'm sorry, I don't want to say this out on recording. I don't know. I predict where I think that it's going to hit support or resistance. And once it hits these levels, they give me an indicator that indicates a certain direction. And once it hits these directions, they've proven to be right when I choose to do these certain lines. And today it happened today at 16.89. I sold, and it went to $18 today, right? Well, what I did was I lost profit on the ride up from 16.89 to $18, but I also made triple the profit from 18 back down to 16.50 on the downside than I would have holding those shares on the upside.
Yeah, and I think that's just something like that beginner traders don't really think about, and I say that because I am one, and I would have never thought of that, and I wouldn't have understood it unless we were doing it together, and then comparing profits at the end.
Yeah, and the idea is that with a seasoned trader, they see a move like that and they go, hey, they want to catch a non-seasoned trader in a move that is not normal to happen, and these guys have been trading for 20-30 years. I've been trading for 17, and you don't see these moves where you make 20-30%. I made 20% on SRAC 6 times on shares over a period of 2 weeks. That is insane. That doesn't happen on a $10 stock.
Absolutely. I do have a question for because I know somebody. It was Toasty Panda. He played SIIC, and I've been playing SRAC. And I talked to you, Fred, earlier about it, and you said that I should pull profits, or you would recommend that per se. And my question is when it comes to a stock that's merging and there's a lot of volatility to it, what's the indication there? Because there's not a lot of measurements or history behind it. So how would you be able to measure that? You know what I mean?
Yes. Okay. That's
Fred,
a
I'm
fantastic.
going to let you touch this, and I'm just going to take a 2-minute break. So if you guys ask me a question, I'll be right upstairs and be right back.
Okay. So this is where sentimentality comes in. Okay. When you are trading any asset, or let's talk about stocks. When you're buying stocks,
Yes.
right? Your opinion about the value of the company, it's your opinion. It doesn't move the stock anywhere, right? You are a single actor in with regards to that particular stock price. Okay, so whether you perceive it that it should be worth $100 or it should be worth $10 doesn't really matter. What matters is how much is it selling now, right? Market participants have determined that through the forces of demand and supply, it is worth $25. Okay, either you want it to be worth $40 or $10 will not make a difference. Please separate your emotions, okay, from the stock price. You are trading stocks because you want to make money from the movement of the price of the stock. You are not trading stocks because you are buying the company. The company, frankly, don't know you from anywhere, right? Unless you can buy 50% plus one of the total stocks out there for the company, you do not own the company, right? So what do I care if the price? The thing is that you see, all market participants come into the market, and once they buy, when the prices start going up, a lot of people jump on board. Okay, they start jumping on board, jumping on board, jumping on board. It gets to a certain point where there's exhaustion, where there's been an over, where demand exceeds supply, and whenever demand exceeds supply, price is going to pull back. And as soon as price starts pulling back, retail traders and beginner traders and even some experienced traders will decide to take profit at this point in time. And when they want to take profit, what are they going to do? They will start selling. That is when there is the pullback. That is when some indicator like maybe an ABC pattern, Head and Shoulders, whatever you can think of, Elliott Wave will tell you that this is a pullback. Because at that point, people have decided that I bought it at $10. You think it's going to 100, but I only think it's going to get $30. So I'm happy with my $20 profit and I'm taking it. I'm getting out of here. If you want to ride all the way to 100, that is good for you. Someone also says that I know it's going to $70. It is now $30 and it's going to come back to $15. So meanwhile, I am going to take my profit at this $30 point. When it comes back to $15, I'll buy again. That is where you can go in and out of the same trade and be buying at separate, different price levels. It doesn't matter because the price at this point in time, that should not affect your decision in buying because you are not buying the company. You are only buying the stock, hoping that you are following the trend or momentum is in your favor. Right. That is why when we were talking today, I said, look, this thing is falling. Get out now and buy it again when you think that there is a place that is a reasonable bottom for you. And it may not be much, but maybe you bought something at $15. It's now $19. Okay, if you sell at $19 and it comes back to $17, you still gain. If you enter at the point, you still gained $2 at this point in time, right? Okay, it could have gone to $20 after you sold at $19, and so what? You got some profit and you got out. You got profit. That's all that matters. You made money on the trade, right? And you can still wait till it's $30 before you go back in and sell at $34. You have still made profit. Do not worry about the fact that you missed out on the move from $21 to $29. That has nothing to do with you because the price did not move because you bought or sold your 100 shares or 1,000 shares. The price moved because there were market participants that were selling and buying and selling and buying, and prices kept going. Sometimes it is only the demand and supply. Other times it is the fundamentals, like we spoke about the last time. They have a new CEO. This CEO he has got a reputation for turning companies around, and so that CEO was employed, and suddenly everybody thinks, "Wow, this company is going to outperform in the next 2 years, next 3 years." And so suddenly the price jumps from $19 to $29. But it's only going to take a matter of time before everybody's going to see that, well, he did very well when he was in a different industry. In this industry, he's not very good. So there's going to be a pullback, right? The value that we placed on it. But those kind of fundamental values, they come in because people are attaching their personal mindsets, emotions to what they are doing. They think that they are buying a company.
Mhm.
you are not buying a company, man. You are only buying a stock.
You're buying a
And
minute.
you are buying you are so insignificant unless you can buy 50%
So
plus one.
can I jump in? I want to ask John H. and Toasty Panda. I know you guys are new to the group, and if you don't mind, you guys mind open up your mics. If you don't know how to, you just unmute yourself at the corner there on your left, underneath where your chat is. And if you guys want, just let me know a little bit about yourselves. If you don't want to, I'll definitely see the pause as you don't want to. But open up the mic to Toasty and John. I want to see what you guys think about what you're learning here, or if you have any questions about it, or you're confused. Don't leave me hanging. I'll keep talking until I see your. Oh, I see Toasty's mic opening up. Toasty, what's up?
Yeah. Hey man. So I'm just like super new. I downloaded Robinhood in June or July of this year
Perfect.
and just kind of spitballing because my boss talked a lot about it, so I just wanted to try it and then got into this. So I don't even really know like where to start. I know you guys do the trainings and stuff, so this is my first one. So like when you guys were talking about, I forget what it was, intrinsic value or something. Like I don't even know what you guys are talking about.
Hey, so
But yeah.
this is perfect, and that's what I want for listeners that are like. So right now, Toasty, I hope you guys don't mind. Everybody, I want you to know this is live. This is streamed on Facebook, YouTube, and it's all recorded. And people like you that are coming that are fresh, I want you guys to understand that we're not here to teach you about only things that you've never heard of, like about stuff that's like crazy beyond your level. And what we've done is we've created a platform for you to learn from someone like me that can teach you the retail level with a high advanced mentality, and then we have people that can teach you a high immense mentality, make you really learn. When you've been trading for 30 years, you can still learn in this group. And what I want you to understand is, coming in new and fresh and you've never traded before, you're just now downloading an app, you're like, what the hell is a share? What the fuck is an option? I don't know what the hell's going on. And every other group out there is going to be like, hey, pay me $50,000, $10,000, $500, $200 to learn this. Well, the good thing about our group is that this information you guys have learned tonight has cost, I'm sure Winfred knows, I mean, this is $250,000 worth of information that you can learn, and we're going to teach it to you on any level that you need to. And that's why we ask for your participation, because we need to know what we need to produce for you guys. So with you, when I asked earlier in the group today, for everybody else, if you're listening, I said, hey, let us know if it's like not the right time or what topics you want to learn about, because what I'll do is I'll put together a video specifically for you, or I'll even take the time one-on-one and spend the time with you, Toasty, and so will Fred, so will Mickey, and we will set you up at the right brokerage. We'll put you at the right places to go and guide you on how to trade before you ever spend $1. You don't need to spend any money as a new trader. You need to go in and get your brokerage set up. You need to understand what you're buying. You need to paper trade and trade with free money. And once you can successfully trade with free money that matches the portfolio that you're willing to risk, then that's what's going to optimize your success. So if you could take, let's say you want to start out with $1,000. Well, you take $1,000 and you put it into a paper trading account, and you say, hey, you know what this is? If you don't know what a paper trading account, it's an account that you can trade with that's going to be no risk to you. And every money that you make on there is fake money, but you can use it as a way for you to start your plan. How do you feel well when you trade? You can't go in with $1,000 and go, okay, I'm going to risk $1,000 on Tesla tomorrow, because you wouldn't do that with your money. You have to go in with $1,000.
Yeah, no.
And you have to say, okay, I'm going to bet $100 on this stock to move 5% in the next 3 months. And if you can do that well enough, then you can start putting yourself in a situation where someone says, hey, what's a good time frame to look at? Well, if you can start reading charts and get yourself in a situation where you can make 5% over a year on one stock, then that's how you become a professional trader. If you really want to know, there's no secret. There's nothing that we're going to teach you that's going to give you a tool that's going to give you anything that's going to make you money tomorrow or next month, unless you're just a guy that is like the beautiful mind. And I hate to be cocky, but I'm that way. I can write an algorithm on the chalkboard, and talk to people about it, and I can break it down, and I can see it. Well, if you can't do that and you're not able to just be like, hey, I know what intrinsic value is because they said the word, so I'm going to write it down. I'm going to go to Google. I'm going to watch 37 videos about it. I'm going to rewatch this video 17 times. I'm going to learn 17 different ways to learn about intrinsic value. I'm going to learn intrinsic value for dummies. I'm going to learn intrinsic value for Kaler. I'm going to learn intrinsic value from Fred. I'm going to learn it from every source I can in the world. Unless you're that person, then what you need to do is you got to take your step all the way back and say, hey, you know what? I need to paper trade. I need to learn from every source of information I can. And luckily, we have over $500,000 of proprietary content that we can train you guys on, and you don't have to go out there and pay somebody $1,000 for it. You get it right here in Elite Trading, and we're going to guide you step by step. Opening your brokerage. What is buying a share? What is selling? What is closing? What is buying a call? What is selling a call? What is buying a put? What is intrinsic value? What is implied volatility? What are the Greeks? What the hell are they talking about? We're going to teach it to you here, and it's going to be literally just you giving the time and coming in. That's what it is. And you sharing it with a friend. I asked you guys, if you learned anything tonight, share it with somebody else because they may need to know something that you don't. And I'm going to end my rant because I know that we're supposed to go till 8:30 tonight. We're 6 minutes past. Is that somebody mentioned luck earlier? And if you don't know what the definition of luck is, it's when preparation meets opportunity. And if you're prepared for a situation to happen, then you're going to meet the opportunity, and the opportunity is going to present yourself in an upward fashion, which is presented as luck. So there's no such thing as luck. It's about being prepared and meeting the right opportunity and then executing that opportunity because you were prepared and you met at the right time. Drop mic.
Too easy.
That's good. Thank you.
Amen, brother.
I think that's a good point to end this. I mean, I appreciate everybody coming in. If you guys have any more things to talk about, spitball, talk to each other. And I'm going to jump off because the wife, you know, what's it called? She flickered the lights. So Kaler's got to go. Once the lights get flickered,
I know I got one
that
too.
means that Kaler's got to go. But I appreciate all of you guys. I love this thing, man. And just share it with somebody else. If you don't pay me a dime and you get all this information for free, the best thing you can do is share it to somebody else and give them the opportunity for free as well.
I will put it on my wall every day. Thanks, bro.
Stay in the green, my friends.
Okay. Bye.